Hello, everyone, and welcome. My name is Megan, and I will be your hostess for today's webinar. We are so glad that you are here, so glad. As we get started, we would love to offer you the opportunity to introduce yourselves in the chat. Um, if you want to share your name, your employer, the size of your employer, and for fun, the song that you're listening to at work these days. Additionally, if you would like to connect with some other similarly positioned employers who are interested in supporting their working families just like you, share your email address so that you can make some connections after the webinar. We are so glad to have you for the first in our series for a stronger workforce. And today's webinar will feature information on dependent care assistance programs. All right. So before we get started, I wanted to highlight some resources that are that are free, that can support your employees. And please don't worry about looking up links right now. You will receive links and more by email after today's webinar. Brighter Futures Indiana offers free, just-in-time guidance to help your employees find, choose, and pay for childcare. Additionally, our Family Resource Navigator can help your employees connect to resources outside of childcare. And several of our web pages and blogs can educate your employees on their children's development. I want to highlight our free resources for finding childcare. The Early Learning Marketplace offers a self-service search tool with filters for cost, days of the week, openings, and more. The OECOSL Child Care Support Line, OECOSL stands for Office of Early Childhood and Out of School Learning. Their Child Care Supports line connects families to real people who can conduct child care searches on their behalf. And Child Care Finder allows families to search for care along a route, such as between work and home. For employees who need childcare to get to work, these resources can be a lifeline. I'd also like to showcase the Brighter Futures Indiana Data Center. The data on these slides in particular hail from the 46060 zip code in Hamilton County, where our expert presenter for today is located. But you can explore the data center for information localized to your community. This first dashboard, the Care Supply Dashboard, can answer the question, what's available near my business in terms of childcare? This next dashboard, the Types of Available Programs dashboard, can answer the question, what's available in terms of childcare during the hours that my business operates, especially if your business operates outside of the traditional 9 to 5. And this final dashboard, the Affordability dashboard, can answer the question, what does childcare cost near my business? Today's attendees span counties across the state, with registrants concentrated in Marion, Delaware, Tippecanoe, Monroe, and Vanderburgh counties. As you can see, in these counties and more, childcare costs roughly double the expert recommendation of 7% of a family's income. We also know from Nobel Prize-winning economist James Heckman that investments in childcare yield a 13% return on investment. The Brighter Futures Indiana Data Center can help you make data-driven decisions to support your employees and your bottom line. To learn about solutions implemented by Hoosier community leaders like yourselves, the Brighter Futures Indiana Communities page features case issue briefs from Jasper County, Rush County, Monroe County, and many more. And finally, to learn more about dependent care assistance programs and other policies to support working families, check out the Boost Your Workforce Through Family-Focused Practices guide created by the Office of Early Childhood and Out of School Learning. It is now my distinct pleasure and privilege to introduce you to our presenter for today, Jon Becker, partner at Church Church Hittle Antrim, an expert in dependent care assistance programs. It's all you, Jon.
All right. Can everybody see my screen?
Yes.
All right. Terrific. Well, thank you. My name is Jon Becker. I'm with Church Church Hittle Antrim. Prior to coming to this law firm, I was 17 years in-house counsel at insurance companies where primarily my specialty was ERISA, group health, group life, group disability, uh, stop loss, and 401k, 403b, 401a plans. So today, we're going to talk about something that's actually quite simple. If you've got a health plan or a 401k plan, to me, those are more complex when it comes to creating them, operating them, and making sure that you're complying with various state and federal laws. But if you don't have a dependent care assistance program, strongly encourage you to consider it. The cost to you is going to be very minimal. It's mainly going to be a payroll slot. Just like with your voluntary life insurance, for example, you have a payroll slot where premium is deducted out of that paycheck paid to the life insurance company. And with dependent care, it is also similar to an HSA or an FSA. All right. So, first, I'd like to start talking about dependent care benefits in general. If you are a parent or if you have any parents, it is a huge financial incentive. My wife and I both did this for the first, I think, 8 years that we had childcare. And the dependent care benefits that we received made a huge difference. It also created an incentive for us to stay with that employer because our employer had a lot of maternity, paternity, and dependent care programs that incentivized people having kids. Kids are a good thing. Without kids, we we're going to lose population, and then obviously we're not going to have anybody to help us as we get older. So, if an employee receives dependent care benefits, the employee can exclude a part of those benefits from income. What are the type of benefits we're talking about? Those can be amounts that the employer pays directly to the employee or a child care provider for care of employees' qualifying person while the employee works. So not only does it include children, but in some situations, it can also include other dependents living in the household. We'll talk about that in a little bit. The employee can also basically not be taxed on the fair market value of the care that's provided in a daycare facility that the employer sponsors or provides. And obviously, if you have pre-tax contributions under a dependent care flexible spending arrangement, those are a great incentive. For us, it was always easier to have that money deducted on a pre-tax basis, so I didn't have to, pay the bill and then try to claim it as a deduction on my 1040. Again, you can reduce salary to pay for dependent care benefits, just like with your health insurance and other benefit plans. Those are going to be shown then in box 10 of the W-2s that you give every year. Just like with your health insurance and your 401k reporting, you'll give that person a W-2. It shows the total amount of dependent care benefits. Whether or not it's going to be taxable or not is obviously going to depend on that taxpayer. But normally, that amount is reported. If you use TurboTax, TurboTax will ask you a couple of questions, and then at that point, it shouldn't increase your taxable income for that year. So one of the things a dependent care benefit is also known as a fringe benefit. Fringe benefits can take many forms. One of the easiest is that if, for example, your employer does mileage reimbursement, if your employer provides any sort of education assistance, tuition reimbursement, your employer may offer you some sort of a business vehicle or free parking, for example. Those are usually not included in income as long as they meet certain tests. Sometimes the benefits are still going to be subject to employment taxes, and that would be basically when you have the market value is more than what the employee paid for it. So if, for example, you provided a mileage reimbursement fringe benefit and you offer the person 1,000, but the employee only spent 500 on gas or mileage, then at that point the difference would be considered taxable income. Still, it's a good thing for the employees. It helps them reimburse them for cost, and when done properly, again, it does not result in that $1,000 or 500 being taxable income. If you look at IRS Publication 15B, IRS Publication 15B will give you many examples of how to set up those plans. We'll talk a little bit more about how to set up a dependent care plan in a second. So,
Jon,
yes.
we have a question in the chat.
All right, terrific.
The question is, can the pre-tax provisions be discussed further?
Yes, and as we get through the presentation, we will actually give some concrete examples. These are all examples out of the IRS. We'll actually talk about the amount that the employer can deduct on its own tax return. But that is a great question. If, for example, I don't answer your question specifically once we get through the remainder of the slides, please do, put something in the chat. We'll make sure we'll talk about that specifically. So, dependent care assistance. This can basically be under what we call a written dependent care assistance program. So when you have a fringe benefit, it always needs to be in writing. Sometimes it can be as informal as a document that you and the employee both sign. But to be reimbursable and non-taxable, the services have to be for a qualifying person. It must allow you to work. And the requirements as to whether or not a qualifying person or qualifying dependent are pretty much the same as if the employee were to claim the dependent care credit. We'll actually go into examples in a little more, but the IRS publication 503 will have specific information. Now, you can only provide the dependent care assistance to current employees. You could do it to a leased employee if you have a PEO. If you're a sole proprietor, you could provide dependent care benefits to yourself. And then if you also have a partner who's not an employee, that person would also be entitled to those programs. Now, again, why do you do these things? Is that when you set it up according to the IRS rules, the amounts the employer pays for these benefits can be excluded. Generally, if they're up to $7,500, then you have the ability for that employee not to get taxed on that 75. If you're married filing separately, then it's $3,750. There are some special rules. Most of your employees, quite frankly, are probably not making over $1 million, and so we won't go into those today. But there are some limits. If, for example, you do have some foreign workers, they may or may not be eligible, and maybe that's a question we could talk about after today. Again, the employee is unable to exclude dependent care benefits. I'm sorry, the employer is unable to exclude dependent care benefits from the wages of highly compensated employees unless the program doesn't favor highly compensated employees. And so you run into the same issues. We call that top. Or in some situations, you have only the officers, the shareholders are participating in a 401k plan. And sometimes you're going to run into some IRS issues because benefit plans have to be offered to everyone. For the exclusion, if you have any owners, operators, shareholders, they are probably not going to be entitled if they're a 5% owner. They received more than 160,000. And then there's also some other things, but most of your workers are probably still going to be entitled, but you are going to have potential issues as to whether or not if an employee who is an owner is in the program is going to have to be taxed on that money. You're going to report the value again, in box 10 of W-2, you also include the amounts the employer can exclude. And so, for example, if you paid somebody $10,000 and the exclusion is only $7,500, then you would report the $2,500 on their W-2. So here's an example. You have an employee that provides a dependent care assistance to employees, and they also provide on-site dependent care as well. The employee paid $7,000 out of their paycheck, and the employee also used dependent care resources the employer had offered. Fair market value of that dependent care was $700, and so therefore, according to the IRS example, you would report $7,700 of dependent care assistance in box 10, and then you would include boxes 1, 3, and 5 would include the $200, which is the amount that is in excess of the non-taxable amount. And so again, in this situation, because the person received a benefit of $7,700, and the exclusion for this year was $7,500, that means that $200 becomes taxable income. Now, in some situations, if you have an employer that provides child care services to employees, then the employer may be eligible for this credit. It covers expenditures for a qualified facility for child care resources and referrals. It is a tax credit on the employer's tax return of $150,000. You're allowed to offset 25% of qualified expenditures and then 10% of qualified resources for child care and referrals. Again, this is an incentive. If, for example, you provide this opportunity to your employees, then you as the employer can also obviously reduce your taxable income, which helps the employer's taxes as well. To be eligible, the employer has to pay or incur qualified expenses during that year. Qualified expenditures are costs associated with basically building or perhaps renovating a building to provide child care on site. They can also be paid to child care workers, scholarships. It can also be used if you have a contract with a local daycare provider. So one of the things we have been working on is where employers are, I'd use the word partnering with local school districts, and those school districts and the employers are basically entering into arrangements where the school district agrees to provide child care for that employer, and the amounts could then be considered an expense on the tax return of the business. The employees obviously could get that tax-free, which is obviously a huge bonus to them.
John,
Go ahead.
We have a comment in the chat. That has increased in 2026 to 40% and 50%.
Terrific. Appreciate that. I actually took this from the IRS publications last week, so appreciate that those need to be updated as well. Any other questions in the chat room?
Not at this time.
All right. So you obviously do want to make sure that it's a qualified child care facility. You may have situations where the facility is not qualified and it's not going to count. But basically, your facility is going to meet the requirements that the Indiana state agency has for child care facilities. It needs to be licensed as a child care facility, and pretty much it has to be open to the employees of the employer during the entire year, which is also important. And one of the other things you're going to see throughout these slides is you can't set up any sort of a benefit program, including dependent care, if that benefit plan would discriminate in the favor of your owners, your highly compensated employees. Again, what are the qualified expenses? Expenses include acquiring, constructing, reconstructing, expanding your property. They could be used for training employees, providing scholarship programs, or increased compensation employees. And again, you have to be careful because if, for example, you provide somebody $10,000, the exclusion is $7,500 for that year, then at that point, the $2,500 would be taxable.
John, we have a question.
Yes.
Do we know if any of these definitions have changed since HB 1177 was passed?
Yeah, so that's a terrific question. We actually will talk about that bill at the very end. That legislation was signed by the governor, I believe, on March the 3rd. That is a state law and a state program. The materials that I'm talking to you about today are from the IRS. And so these are out of the IRS publications. And they deal with federal income tax and federal business tax returns. Um, in essence, that bill and any state legislation that would create economic incentives for employers probably are not going to impact their federal tax returns. It would not impact a person's federal income taxes that they report on their 1040. Now, when you have a state law that impacts a deduction, you and I would be able to take that deduction on our Indiana return. So, for example, when I used to rent when I was in college, there was a renter's deduction that I could take on my Indiana state return. At that time, I was not able to take a deduction on my federal return for the rent that I had paid. But that's a great question.
John, we have one more. This comment says 45F at the federal level now includes intermediaries as a qualified expense.
Good to know. Thank you for sharing. Um, when we're looking at how to claim the credit, according to the IRS materials that I located last week, you're going to use Form 8882. Again, the credit can't be exceeding 150,000. You can deduct eligible expenses that exceed the amount of the credit determined. Look for the instructions. Today, obviously, I'm not able to provide you specific tax advice, but I would be happy after the presentation to talk about any specific transactions that you may want to learn about. One of the things too is there's no double benefit allowed. So if you took an expense somewhere else on your return, you can't take it a second time, which is pretty much a no-no when it comes to the IRS on other things as well. All right, we've already talked about Form W-2 reporting. Obviously, you're going to have your systems in place. Most of the time, if you're using ADP or other payroll systems, it's going to track dependent care dollars, and then it should report those on the W-2s for individual. So now I'd like to talk about flexible spending arrangements, which a dependent care reimbursement program it is. So many employers have an FSA that offers to reimburse for health expenses. We're talking today about a flexible spending arrangement to reimburse for dependent care expenses. So these accounts are usually funded 100% through salary reduction. The bonus to the worker is that it would be put into an account with a bank, similar to an HSA account for health insurance expenses, and you don't have employment or federal income taxes deducted from the contributions. When you use the money for eligible expenses, then the reimbursements are also tax-free. So if you deducted $1,000 out of your paycheck, you use $1,000 to pay for dependent care expenses, and the program was set up correctly by the employee will get a dollar for dollar to be able to pay their daycare provider. If you don't have a dependent care program, the worker would have taxes taken out. So let's assume they're at a 20% tax rate. So that $1,000 that they paid to on an after-tax basis, they actually lost potentially $200 to the federal government. And while we all do need to pay our own taxes, and that's coming up on April the 15th, one of the things with dependent care, just like with health insurance premiums, you can deduct these on a pre-tax basis, which then is obviously better for the worker and better for families with kids. So how do you qualify for an FSA? FSA are created by employers. You can have multiple FSAs. You can have an FSA for obviously health expenses. You can have the health, for dental expenses, one for dependent care. If you're self-employed, unfortunately, you're under the IRS rules, you can't have an FSA. Again, FSAs are also limited if you have highly compensated participants or usually your owners and shareholders. So how do you do this? Well, usually during open enrollment, which is oftentimes in November, you will have the employer provide applications for health insurance, life insurance. It's probably the best time to do this is to give them what is known as a salary reduction agreement. Basically, it could be a letter, it could be a form, it could be online, and it basically says, employer, I want you to take $1,000 out of my paycheck. I want you to do that on a pre-tax basis, and I'm going to be using that for daycare expenses. Now, each year, which is usually going to be January the 1st, the employee has to designate what that amount is going to be. And so if, for example, you had $5,000 in dependent care expenses, but you only designated to have your employer take out $1,000, that $1,000 pretty much is set for the entire year. And so you do want to try to calculate what your dependent care expenses are. When my daughter was in daycare, we estimated $150 a day, which is probably cheap 15 years later. And we took out as much as we could, basically calculating how many days a week we needed the daycare, how many days was going to be summer, and how many days we were going to be on vacation. But normally, once you make that election, it's irrevocable, just like health insurance is irrevocable unless you have some sort of an event that is allowed by the IRS, which is usually going to be, a death, divorce, or the addition of a baby or adoption, for example. So generally, distributions from FSAs can only be used to reimburse for qualified expenses. You have to elect the amount every year. When you're submitting a claim, you usually have to provide receipts. And so what I would do every quarter is I would actually print off the invoices that I had paid. I would then submit that to the FSA bank. FSA bank would then reimburse me via a check. With these accounts, you're not allowed to make advance reimbursements. So I was only able to get reimbursed for the daycare expenses that I incurred. And so one of the things is that if, for example, your child is going to turn over the maximum age, you would not want to have 100% of the amount taken out for that year. If, for example, your child is only going to be able to be eligible for the first 6 months. One of the negatives about an FSA, if there is any, is that it's use it or lose it. So if, for example, you incur $500 in dependent care expenses, but you had $1,000 in the account, you don't get to keep that $500. There is a grace period. And so usually what I would do is that when I did my tax returns in April, usually in February, March, I would go back and then make sure that I had submitted all my receipts. And as long as I submitted receipts for the prior year, I usually was able to get reimbursed. So we've talked generally about the FSA. A dependent care FSA is basically a dependent care benefit plan. Again, it's on a pre-tax basis. Now, what are some examples? Preschool, summer day camp, before and after school programs, child and adult daycare. There's actually a website there that will give you a helpful checklist of everything that is eligible, and it also gives you a checklist of everything that's not. To me, it is a simple way to let your workers save money while taking care of loved ones so they can continue to work. And obviously, a happy worker is a productive worker. And as a parent, I remember that first day dropping my kid off and thinking, what did I just do? Because I don't know who these people are. So obviously, if you know that you've got good childcare, you're going to have the ability to focus in on work, which is obviously good for the worker and for the employer. Why offer dependent care? Reduces, again, employee taxes. It's easy. It's a payroll slot on the person's paycheck. And then the employee decides when to submit the claim and then when to get reimbursed. Sometimes we personally will submit medical bills monthly with dependent care. Sometimes I did it quarterly. Most of the time I was doing it once a year. And that was always nice to get that money back, because then you could use it for a lot of different things, including vacations, or if you have a 16-year-old buying a new car. So, when are these expenses eligible? The child has to be under age 13. So again, going back to that example, is that if your child is turning 13 in June and expenses are incurred in July, your July expenses will no longer be eligible because the child is over the maximum age. We used it for before and after school care. We actually used it for babysitting. So we had a local high school girl, and it was convenient for us. We actually were able to pay her, and then I would get reimbursed by submitting, the bills that she would send to me. Daycare, obviously, nursery school, and preschool are all eligible. The other thing we used our reimbursement plan for was summer day camp. So we had my daughter was at the zoo, and the zoo has a great summer day camp program. I think it was for 2 weeks. We were able to basically pay the zoo for her to go to that day camp for 2 weeks, and then we got reimbursed out of the account. You can also use these accounts for spouses and relatives who live with you and they're not able to care for themselves and live in your home. So if you have perhaps maybe a parent or an aunt or an uncle and they're permanently and totally disabled, you actually, in some situations, can get reimbursed for those expenses as well. So it's not just limited for children under the age of 13. But if, for example, you're using it for someone over the age of 13, they obviously are going to have a medical condition that impairs their ability to be by themselves. All right, so somebody had already beat me. On March the 3rd, the governor has now signed HEA 1177. This is a state law, not a federal law. So this is going to impact your state returns, not your federal returns. It increases the maximum number of individuals an employer can employ to be eligible for the employer child care expenditure income tax credit. It allows Indiana employers, again, this is for Indiana employers who are filing Indiana tax returns, but this provides that cost incurred for operating a child care facility, or if you've got a contract with a child care facility, those are qualified expenditures for purposes of the employer child care expenditure income tax credit. It also allows a redevelopment commission to use revenue collected in a TIF district to spend money to provide financial assistance to entities. So those employers can create construction or expansion of child care facilities. And so, one of the things the Indiana legislature is obviously very well aware of is that there is a shortage of supply of daycare facilities, and there is certainly a demand that exceeds that supply. In the city that I live in, we've got a new daycare provider was constructed in the last 6 months. My guess is that the reason that location was selected is because they received a TIF, or the ability to avoid paying property taxes on the land for a period of time. And so with this HEA 1177, I think it will create incentives for your local towns and cities and townships to provide potentially property tax reductions or breaks. And hopefully that will then spur other companies to basically either locate their childcare facilities or perhaps build new buildings so we can provide more care to those people. I, at this point, don't have any other slides, but I'd be happy to answer any questions regarding any of the topics or other topics that may be of interest to you.
Now's your chance. We've got a lawyer. Okay. You can ask any questions you want, and he will answer the ones that he can answer. As you're thinking of any potential questions, I'm going to go ahead and share just a couple more free resources. with you as we go ahead and wrap up. So, John, I'm going to take over screen sharing if that's okay.
That's terrific. Thank you for your time today. If you do have any questions, my contact information is here. Feel free to send me an email or a phone call, and I'd be happy to help you with your next project. Thanks again for allowing me to share today.
John's great, y'all. Yeah, just good, solid person. So definitely take him up on that offer if you do have questions after today's webinar. All right, so thank you, John, for educating us about dependent care assistance programs. Wanted to let y'all know about our next webinar in the For a Stronger Workforce series. This webinar will feature the founder of the Parenting in the Workplace Institute, the former executive director of the Boston College Center for Work and Family, and the CEO of the Milk Bank here locally. There's a QR code on your screen. You will also receive a link after this webinar to register. So register if you are interested to learn more about policies that will support families in your workplace. And one final slide for you. Before we go, please let us know how we did. Scan the QR code. You will also receive this link in your email. This 4-question survey will take approximately 2 minutes and will help us as we continue to support Hoosier employers in this webinar series. And follow us on social media for more early education supports for your employees. Thank you so much for your time. I know it is incredibly valuable and limited. Thank you for attending. Keep an eye on your email for resources that are coming your way, and we hope you have a wonderful rest of your day.